Right, we have a quorum. Welcome to our afternoon session, ladies and gentlemen. Thank you for sticking around for this part of the day. What a good panel we just had before the break. I don't know if Sasha is still here, but I wanted to say that even dolphin-friendly soap can ease some pollutants, as I've had to tell my teenage son over the years. We have a panel now on the subject of impact investment, mobilising assets and portfolio management. I'm delighted to be joined by, I think I'm going to call it our super group, given that we all have microphones, a really diverse group of central banks, we have investors, we have banks, so really able to look at all sides of the capital equation here. And I'm joined by, to my immediate left, Sophie Joanni, who is Head of Investor Relations at ILX Fund. Sophie, welcome. With by Yuan Gao, who is Vice President of Fixed Income Currencies and Commodities at CICC UK. Welcome.
Thank you.
With Yvonne McCarthy, who is Head of the Climate Change Unit at the Central Bank of Ireland. Welcome, Yvonne. And with Michiel de Smet, who is Sustainable Investment Expert at the National Bank of Belgium. We've talked a lot about frameworks today, so I'm going to just set a framework for this discussion on the topic of impact investment. This is a term that's been around for a long time. I remember probably first coming across it maybe 20 years ago in the world of wealth management. The idea being that, you know, wealthy people were giving away money in philanthropy and their money could go further if they were to invest it for an impact. It's not necessarily always a term that we hear today as we talk about climate change, finance, transition to net zero. So to frame the discussion, I just wanted to ask each of the panelists what they consider the term impact investment to mean. And I'll just start on my left and go along. So, Sophie.
Just to give you a bit of a background, ILX is an Amsterdam-based asset manager, and we specialized in global development finance co-investment strategies, and more specifically in private credit investments. What we invested in, what we consider as being impact, is anything which would be SDG related. We have obviously also a large focus on climate finance. So anything which is SDG related that we can measure.
Thank you, Sophie. Yuan.
So just give everyone a bit background also about CICC, China International Capital Corporation. So we are basically the very first investment banks in China, and was originally founded in 1995, joint venture between Morgan Stanley and the China Construction Bank. Right now, we are basically largest shareholder is the Ministry of Finance of Chinese government. So what we try to achieve through this impact investment with Chinese characteristics is a responsible investment framework which covers, empowers innovation, and in the same time also we're trying to empower both the investors, the society, as well as the issuers to making impact which is aligned with the international standard of ESG. Right now we have this ESG as well as the original Rockefeller's philanthropy's idea of impact investment.
Thank you. Yvonne.
Thanks, Clive. I think we're all aware that impact investing is a very broad term. It encapsulates lots of things around having positive impact in addition to financial returns, but it's probably no surprise that in the central banking world right now there's so much focus on the climate aspect. And that's because climate change is such an existential threat that poses financial risks. And we all know that there is a need for the world to transition to a net zero state, and to do that, it's going to require very significant investment. So from that perspective, there's no surprise that, we talk a lot about impact investing in the context of climate change. That said, there is of course still room, and there's still growth in the other aspects of impact investment as well, around the social issues and sustainability more broadly. But I think the big question really is, how do you actually measure impact? And in that context, there's some interesting work, in the European context. ESMA recently published some proposed guidelines on fund names and kind of who can use the term impact investing, what it actually means. And in that context, they're proposing that impact investment actually needs to be assigned to a quantifiable, measurable target. So if you're going to use the term impact investing in your fund name, then you need to be able to meet measurable targets aligned to that. And I think in that context, that's work that obviously the central banking community across Europe is very involved in, and also especially at the Central Bank of Ireland, we're very heavily involved in that. We chair the IMSE, the Investment Management Standing Committee, that's overseeing a lot of that work. So I think that's a question that we need to keep our mind focused on. How do you actually measure impact? And that's definitely a focus within Europe.
Thank you, Yvonne. And to you, Michiel.
Thank you. So we've already seen 3 different perspectives. I'd like to add a 4th one, which combines some of these elements. I like the definition by the Global Impact Investing Network, which says there have to be 3 elements. It's investing with the intention of positive social or environmental impact in a way that is measurable alongside financial returns. So it's intention, positive impact, and quantifiability. So in the case of climate change, that could range from grant capital, concessional capital, to end deforestation, or to phase out coal, over smaller private allocations to social enterprises that innovate in renewable energy, down to listed climate solutions like green bonds investing in renewable energy.
I mean, do any of the panelists have any concern that other areas that require impact investing, education, healthcare, food, are slightly falling by the wayside here, or being left behind by the urgent need to deal with climate, or is this all interlinked and under the social banner as well?
Yeah, happy to go first. So I think it's fair to say that climate change, renewable energy, green bonds are high on the agenda. We also see a relative drop in the share of, if you look at thematic bonds, ESG bonds, of social bonds compared to green bonds, regardless of the absolute drop that we saw in 2022. However, having said that, especially in traditional impact investing, that investing into education, into health, into social housing, into reskilling people still is very much alive. Going forward, looking at social bonds, sustainability bonds, potentially sustainability-linked bonds, I think that is it's an interesting space to keep an eye on.
Anyone else on the panel with a view on that?
Well, I would say it's the same for ILX. We have a pretty broad view where climate is important, obviously, but we're looking at the SDGs in general, which would mean that our clients are looking for impact in 4 economic sectors principally, which would be energy access, clean energy, sustainable industry and infrastructure, and also inclusive finance and food security. So it's a broader sense. Obviously, as my colleague said here on the panel, there is a focus on climate, but it's general in a way that we're trying to align and have measurable positive impact in a broad area of the good, if you want to call it that way.
Yeah, well, there are a lot of aspects to this. There's going to be a poll going on during this panel. Those of you in the room probably know, hopefully now, how to do the poll. You'll have an app which you can download off the agenda or the booklet of the day, which allows you to vote. And those listening in or watching us online can vote by clicking a button on their screen. And the question is going to be quite a straightforward one. Should impact investors accept a lower return? We'll discuss the results of that a little bit later. Obviously, impact investment, it certainly started with people saying, well, I'd take a slightly lower return in order to make an impact. But I wonder whether that's the case now. Let's move on to the substance of this discussion. I'm going to come to you first, Michiel. I'm doing the research that all of us do by looking you up on LinkedIn. I saw that you describe your role thus: at the National Bank of Belgium, I focus on the financial system as a powerful force to address climate change, biodiversity loss, and other global challenges. So I just wanted to ask you, how do you think the financial system is doing?
I'll try to go around that question. I think first of all, yes, it's not just climate change. Going back to your earlier question, it's also about biodiversity loss. It's about social inequality. So it's important, as we saw in the previous sessions, that if we do finance projects, companies, that we understand how we address multiple challenges at the same time, or at least be aware of the trade-offs that might be there. Now, how's the financial sector doing? I think we need finance. They've got an important role to fulfill, and that is the entire spectrum of finance: grant making, traditional grant making, societal impact-focused finance, concessional capital, traditional impact investing, all the way down to or up to traditional investing. It's encouraging to see that across that spectrum, we see products emerge, we see impact funds emerge. I think it's time to accelerate now. So we've been testing certain products. We at least understand that they do have impact. Some of them have measurable impact. So where we have learned that a product in innovation works, let's then pick it up and accelerate it. And I think it's high time to do so.
Give us a couple of examples of products that you think are working then.
So if you go to listed products, think about labeled green bonds, ICMA line bonds, Climate Bonds Initiative, in future potentially the EU Green Bond Standard. Understanding how the proceeds are being used, understanding how they've been selected, how they've been reported afterwards, how the proceeds have been allocated, so getting a certain guarantee that the proceeds have been used for certain causes. Say, for example, energy efficiency, renewable energy capacity. I think that would be an innovation where you're like, yes, this works. Let's understand how we can scale this. On the other hand, we look at sustainability-linked bonds. In principle, in theory, great innovation. In the past few months, we've seen there still are a few bumps, as we called it in the previous session. And that's fine. I think that's a sector that's maturing. So let's understand what works, what types of indicators, KPIs we use, what the step-up could be. And then take those learnings with us and well, take that sector as well further.
Thank you, Michiel. Maybe Yvonne, you could just explain to us a little bit about the mandate of the climate change unit at the Central Bank of Ireland, and then also talk about, you know, some of the stuff that Michiel was just talking about, that in terms of what you see in terms of what's working and what's not.
Sure. Well, in the central banking world, we'll all be quite familiar with the fact that climate change has moved very high onto the agenda in the central banking world in recent years. And at the Central Bank of Ireland, the way that we've taken a strategic approach to climate change, dealing with the challenge that is climate change, is very much a strategic focus for us. And so we established a new climate change unit just over a year ago, really, just to, I suppose, drive forward the central bank's ambition in relation to that. And what we mean by that is we want to get to a space where we're incorporating climate change considerations into every aspect of our business. So we want it to become part of our DNA. And at Central Bank of Ireland, we have a very broad mandate. Our job is to ensure that the financial system is safe and sound, that we've got financial stability, that we support monetary stability, but also we have a conduct mandate, which is very important in this space. So it's about ensuring that the financial system works in the best interests of consumers and investors and the wider society. So in that context, a couple of key priorities for us are around incorporating climate change considerations into our supervisory activities across all sectors, to make sure that financial firms are actually embedding climate change into their own operations and taking the task seriously. And of course also that we're working to build capacity, not just within the central bank, but also across industry. And in that context, we established a cross-industry forum where we bring together sectors, representatives from across the financial sector in Ireland with climate experts and ourselves, because we recognise that capacity building is so important to tackle this challenge, not just for ourselves, but also across the financial system. So I think that's just to give you a flavour of some of the things we're talking about and some of the things that we're doing. I'm very happy to pick up on any of those later. But I think in terms of, the financial system and talking to some of the points that Michiel's making, I mean, I would say that we are seeing now a real embedding of climate change considerations into, and ESG considerations into the financial system. I think that's very promising. In the European setup in particular, we know that there's a very substantial body of work around developing a sustainable finance framework, which actually provides the architecture off which to hang all of the other pieces of the product development and all the work that goes with that. But at the same time, we're now moving into a different phase, which is a little bit more about review and testing the system rather than the products. Actually making sure that the system that we've designed as it's currently working, that it's actually usable, that it's actually designed to be fit for purpose. And in that context, the European Commission, it has its version 2 of its sustainable finance platform kicking off. And a big part of what they will be looking at is taking feedback and bringing that feedback to the Commission about the usability of the sustainable finance framework in Europe and the work that needs to happen to increase the efforts, because, you know, again, it's really positive to see so much development, but as I mentioned earlier, and as so many people have mentioned today, the scale of investment that's needed here is enormous. So, you know, the financial system is tackling the challenge, and products are emerging to tackle that challenge, but it's nowhere near where we need to be, and we have quite a path ahead.
And the version 2 you described, do you think that will be a big step forward, or will we have to wait for version 3, version 4 before we get to the point where we're all happy with how that actual product side of things is actually coming along?
Yeah, I think, look, I think things are developing very quickly here. They have, I mean, if you'd asked me this 10 years ago, I wouldn't have expected us to be where we are today in this context. So I think it holds a lot of promise, and I think that the mandate is right. The kind of focus of version 2 is right at this juncture. But in terms of, I mean, you might want to talk later about green product development a little bit more, so maybe I won't get into it now.
I just wanted to ask if you can answer this. You talked about sort of encouraging members of the financial services sector in Ireland to adopt certain practices and principles. What do you do if they're reluctant or they're falling behind? What's the role of the central bank then?
Yeah, so I mean, as a regulatory authority, of course, we have enforcement powers, and, you know, we actively use those enforcement powers if we observe that the financial system is not operating in compliance with the regulations as they are laid down. Of course, we're in a very new space when it comes to climate change and sustainable finance, and we really are still in very early stages of, you know, implementation, if I'm to put it that way. So if you take an example, SFDR, Sustainable Finance Disclosure Regulation, for example, level 1 in place for just over a year now, we have been doing supervisory work at the Central Bank of Ireland across the funds industry, for example, to look very closely at how funds are responding to SFDR. Are they meeting the requirements of the regulations? And what's really important in that context is that we actually communicate with the funds industry, with the general industry, not just on our expectations, but also on what we're finding. So there has been a process of communicating our expectations, undertaking thematic specific SFDR type supervisory investigations, and just last November we held an event where we talked about some of the findings from that work, and it is important in that context that we share examples of best practice and that we use those examples to propel further learnings and you know, work in that space. But of course, in time, you know, as I said, it's very early stages yet, and the regulations are still going through phased implementation stages, so it's still very early until the whole framework is in place to really talk about these issues in great detail.
Thanks, Yvonne. Johan, I want to go to the specific role of an investment bank in a second, sure. But just to sort of like, you know, continue this discussion about how's the financial system doing. What's your perspective on that?
That's a tough question, considering I think I'm the only speaker from a Chinese institution today, probably also including tomorrow's session. So what I want to highlight is I just traveled back from China last week for a 2-week business trip. And what I have seen is very promising. The recovery is very fast. And China has really paid huge attention to this sustainable investment, ESG, as well as green bonds area. We'll go to that later. But giving you a few examples, some data. So in 2016, the whole issuance of green bonds in Chinese market is less than 50 billion Chinese yuan. And guess what's the amount of last year by the end? It's over 850 billion. So it's more than 10 times over the 6 years. And unfortunately, CICC was a leading underwriter of over 20% of those amounts, which is a pretty. But in the same time, we do realize the popularity of all these system-linked products, as well as green bonds, blue bonds even. They are all very popular among investors in China. And the whole market right now, so as we come to Mikhail's point, is about how we link the measurable, quantitative measurable measures, as well as how the two different systems, because as we look into the G20 countries, each country has its own merit, each country has its own specific economic characteristics, and how we really link those together is really require a bit more framework from international global vision. And how that achieved? So China now is co-chair the G20 Sustainable Framework Working Group with the other power, and the G20 Framework for Transition Finance is also undergoing, which making huge progress. And the last year, in 29th of July, China published, the government published the China Green Bond Principles. And these, what I want to highlight here is that these principles share the exactly same 4 core components of EU Commission's Green Bond Principles. And that's fully aligned. And one of the focal points of that principles is the use of proceeds, and which was not 100% in the green area, in the sustainable linked area before. And this alignment between China and the EU's green bond principle really bring the not only government bonds, policy bank bonds, local government bonds, 100% of UOP use of proceeds, but also the China corporate bonds become 100% UOP as well. The only remaining is enterprise bond, which supervised by NDRC is going to merge into also going on the way to 100% with a new 2 sessions just finished in China in March. So that's give you some idea about how the Chinese in China, the market is doing and how the system is doing. It's a top-down process. So it has PBOC, the central government, the central bank, sorry, and it also has a number of regulatory bodies. So with the recent 2 sessions, is undergoing some reform. So I can't comment too much on that. It's not there yet. But from a market players' perspective, what we see from both issuer side as well as those green projects and investor sides, this area is booming.
Let's come to that issuer-investor relationship in a minute. Mikhail, I'll just bring you in.
Yeah, I wanted to give an idea of the size of the scale. So as Yuan was saying, green bond principles, whether in China, whether in Europe, other jurisdictions are maturing. Taxonomy is maturing. We might come to that. There's a common ground taxonomy, which combines elements from Chinese taxonomy, EU, other jurisdictions. So as those building blocks are being laid, it actually is time to scale now. If you look at the fossil fuel banking versus renewable energy banking ratio in terms of how much money is being spent on financing from a banking point of view, but also from an investment point of view, we should be at 1 to 4. To be clear, 1 fossil fuel, 4 renewable energy, and at the moment we're standing at 1 to 1. So if we want to move towards net zero by 2050, we drastically need to increase that one. So as those building blocks are there, it really is time to redirect those capital flows and get those numbers higher. So that's roughly the bit of the scale of the challenge that we're facing.
Thanks, Mikhail. I'm going to come to Sophie now, because I think what ILX is doing is very, very interesting in terms of mobilising assets. And it's in a particular space with a particular group of investors at the moment. Maybe you could talk us through a little bit about what ILX is doing, Sophie.
Sure. As I said, we invest primarily in global development finance co-investment strategy. So we invest in UN SDGs and climate finance focused private credit instruments in emerging market. And we invest alongside MDBs and DFIs. I just want to give a bit of an overall view of the market to understand why we invest there and why it's so important to mobilize assets towards that kind of new asset class. First, in terms of emerging market, which is the market we focus on, we definitely believe if we focus on climate, that the fight against climate change is going to have to be focused quite a lot on emerging market. Emerging market and development economies account for 2/3 of the greenhouse gas emissions, and many are highly vulnerable to various hazards. So there is 2 issues for emerging market. The first one is the transition, and the second one is the adaptation. How do they adapt to the physical effect of climate change? And that implementation is going to have to be accelerated. But it's also going to have to be in a way where it does not disturb the economic and social interest of the people that are first-hand impacted. And if you look at the financing need to achieve that in emerging markets, it's estimated by various entities to be at about 4.2 trillion annually. And meanwhile, you compare that with the official development finance amount of money which is there to support the emerging markets. It's limited to about 160 billion. So there is a massive gap here. And the only way to fill that gap is to look at the assets under management of the pension funds. If you just give you an idea, the pension funds, the 20 largest pension funds run about 20 trillion. So this money has to be somehow channeled towards emerging market. There's been a lot of interest of pension funds to invest in emerging market, to invest in sustainability. However, if you look at the capital market, to go back to your question, if you look at the capital markets of these local economy, most of them, the only way to invest is via tradable and listed securities. And that being said, it's not in all the critical sectors, and it's not necessarily easy to have a measurable impact when you invest that way. So when there is not a well-functioning capital market, and some of these markets actually do not have one at all, the role of the MDBs, which historically have been there where the private sector has not been, is really critical. They can work to deepen that local capital market. They can create kind of a conducive business environment for private investors to come in, being catalytic to come in with them. And that comes to the crux of what ILX does, in a way that we are the linchpin between the MDBs that have a local presence, a deep knowledge. They also have ESG safeguardings. They have all kinds of data and experience in those local markets. And then at the same time, ILX is offering a scalable product for these pension funds because they cannot invest at the small project level with the MDBs. So we offer to them the ability to invest at a scale with a very diversified portfolio across sector, across industries, across countries, across regions, with accurate returns. We'll talk about that later, the returns. And also with data transparency. We report on everything. And I think that's the key, is that the pension fund money wants to go and help, but there is no conduit to it. And in some ways, ILX is offering one of these conduits. I'm sure there are others out there, but this is one of the conduits where we invest along the MDBs in order to rely on their experience and their market setting in terms of impact that they have done over the years.
So from your point of view, if we think about agents of mobilization, pension funds have to be at the top of the list, do they? They
definitely have to be at the top of the list. Obviously, there are other pools of capitals. In terms of the private pools of capitals, you have sovereign wealth fund that you would classify slightly differently. You have the banks, you have the private banks, but the pension funds in general, some of the largest pension funds are our clients, are always leading the way in terms of trying to create a new asset class. This development finance asset class would be new, and the pension funds are always a bit ahead of time, especially in Europe and especially in the Nordics and in the Netherlands.
Thank you. I mean, Johan, in terms of your role as an investment bank, how do you see the investor group that effectively funding these markets? How do you see that developing at the moment?
I want to bring a bit of color of the comparison between the world, basically developed markets and emerging markets. So developed markets, as Sophie mentioned, the pension contribute a lot. It's over 20 trillion US dollars asset under management. But like developing markets like China, the pension is big, but the market is not that big at all because most of the assets are holding in banks. So that's a special, clear difference lies there. But with a demographic aging populations also in Asia, not only China, but Japan and South Korea, etc. So the pension industry in China is also going to under a reform in future, in very near future, which is more will bring the pension industry more closely to what we have here, but still it's different. It's 1.4 billion population, so it's not the same scale and it's not the same distribution as well. So, but in the same time from our asset owner in mainland China. Right now, how CICC helping with this space is through major three perspectives. One is we try to help with financing. So if there is a construction project which has a sustainable link, we can help as an investment bank for financing. If there is a small, medium-term businesses which also has a sustainable ESG link, particular climate link, what we can do, we can directly invest in those projects based using CICC capital. So we have 7 pillars to base. So the 7 pillars including equity, fixed income, wealth management, investment bank, asset management, and CICC capital, which is a private equity type of business. And we also have the 7th pillar from last year end, which is international. It's also addressing some of our priorities going forward. It's not only look at China, it's beyond China. Because what we see is environment and climate, they are public goods globally. They are not just for developed world or emerging markets, not only just for Europe or Asia, but also Africa, and also South America. So we need to think all this holistically from a top-down perspective. Also, in the same time, we need to understand the local market. So it's ultimately, with all the regulations, with all this taxonomy aligned with the framework set up, it's still a people-to-people business. We need to understand our customer, not only by looking at news, reading news, looking at television, TikTok, YouTube. We need to talk to people locally. So that's why I'm here in London, talking to everyone here. Because what we really want to hear is how our clients, central banks, investors, what's your concern about investing in China and what we can help? And what's your concern about Chinese investors here and what we can help? So those are different ways of services we are currently working on. And it's a different system, but ultimately the trades still going on. From a commodity space, we can see most of the trades, even with this deglobalization, the trades are recovered really fast with all this post-COVID recovery. So I do encourage here everyone, like, if you are interested, come to me later and let me know what's your thoughts about China. And if you're interested, happy to have further conversations.
I'm sure plenty will take you up on that, Yuan. Just on this subject of mobilising assets and the drivers of that mobilisation, Yvonne, what are your thoughts on that?
Well, from a central banking perspective, I think we look at this from a different lens, which is that, firstly, I suppose we play a very important role in making sure that can happen. But what I mean by that is that it's our job to make sure that the financial system is actually resilient to the risks posed by climate change, so that it's actually capable then of being ready to support that transition. So I think that's one aspect to that in terms of mobilising the assets. We have quite a big job to do there, and we heard about some of that work earlier on today when we heard about stress testing approaches and the like. So I'm not going to repeat it now, but that would be one aspect. I think also from a central banking perspective or a regulatory perspective, it's important that we support innovation, because this is a very new space, and perhaps a lot of the products that will actually mobilise assets are already in existence, but perhaps they're not. So we have to be able to support innovation and actually test and learn what works and what doesn't. And in that context, access to sandboxes and the like, we have one at the Central Bank of Ireland, but they're really important. It's a really important part of the puzzle, I think. And then finally, I think that asset mobilisation, what's really critical here is that there is a sustainable finance framework, that there is clarity on what we mean by green assets. And that's why all of the work that we're hearing about across the whole day so far around globally the approaches that are being taken to define what is green, what's not green, what are green products, what kind of criteria do they need to meet. All of that work is still at a very early stage, of course it is, but it's critical, because without that, assets may be mobilised, but perhaps not in the right direction.
What direction might they be sent in then?
Well, I think it's more, thinking about the risks of greenwashing, in the context, and there's obviously a lot of discussion about greenwashing now, and there has been over recent years. And I think in that context, as a regulator, as a central banker, we see greenwashing as a very sizable, potential, significant risk that could damage things significantly. Because if you think about what greenwashing is, it's a form of mis-selling. So, of course, it's harmful for consumers and investors generally. If somebody is being sold a product that doesn't accurately reflect the underlying sustainability characteristics, if they're kind of misperceived perceptions about what a product actually is, and that's very worrying. But I think what's also worrying is the fact that greenwashing in and of itself, can undermine the development of the sustainable finance market, can undermine asset allocation if it becomes a problem. And I think we need to be really alive to that issue. And in that context, again, it's something we take very seriously at Central Bank of Ireland. We have a whole suite of work underway around looking at the existing architecture that exists. Like I mentioned, the SFDR, the Sustainable Finance Disclosure Regulation. That type of regulation has been designed in ways to prevent the problem that is greenwashing, by putting clarity to what we mean by green, by putting clarity to what kind of a fund, for example, can classify itself as green. So we have a body of work underway to actually look at those issues and assess whether funds, for example, are truly green when they say they are. But I think more broadly, beyond that, in a European context, if you can forgive me for speaking about Europe again, the European supervisory authorities have all been mandated by the European Commission to consider the topic that is greenwashing. They've been mandated to actually look at the issue, come up with examples, to take feedback, to publish consultations and the like, and that's a process that's ongoing at the moment. And there will be an interim report published around May of this year, and then a final report about a year later that's going to call out all of these issues around greenwashing. What does it look like? Why are we concerned about it? What does it look like? To what extent does the existing framework perhaps even present opportunity for greenwashing? To what extent does the existing regulatory framework potentially, to what extent is it sufficient to prevent greenwashing? All those kind of issues are going to be tackled. So it's a very alive debate. It's a very, pressing issue, and it's something that there's a lot more to come on over the coming year.
And as we heard in the panel just now, I mean, even issues like the terminology, like people don't understand what stewardship means. These are complex issues that need to be solved quickly. Michiel, we've opened the greenwashing tin, so let's dive straight in.
Yes, thank you, and I'm very happy to complement Ivana's comments here. So I'll be talking from an own reserve management point of view. I'm part of the investment team that looks after our non-monetary policy portfolios. So I'm not talking about monetary policy nor about supervision, but it's a similar story there. So why do we look into sustainable and responsible investment? I think the reasons are twofold. On the one hand, we want to anticipate ESG-related risks that could be of reputational nature, obviously, but also could be climate risks, as we've been discussing earlier today, transition risks, physical risks. And then the other side, or the other reason, would be supporting that transition. And as Yvonne was explaining as well, you want to do a proper job in order to support the transition towards a net zero economy. Examples of how that is then implemented at the National Bank of Belgium is, for example, the climate-related disclosures, which we will be doing in the context of the Eurosystem. European Central Bank President Lagarde announced this earlier this week, so over the coming days and weeks you'll see more disclosures coming from Eurosystem central banks, including the National Bank of Belgium. And then we'll also be making public announcements about our sustainable and responsible investment strategy. And I think that nicely links to being transparent, mentioning what labels you expect, how you go about exclusion, how you go about investing in green bonds, how you go about disclosure, and building that trust, as we've been discussing before. And I think, well, going back to the question on greenwashing, it's through that transparency, through referring to international frameworks, well-known concepts, explaining it, that you build that trust and can mitigate the risk of greenwashing or being accused of greenwashing.
And yet, for all the coordination and trying to have established standards, I mean, at ONFIF we do quite a lot of work with emerging market sovereigns thinking about doing GSS bond programs. We had a big issuer from Central Eastern Europe visit us to meet a large group of investors a couple of weeks ago before they do their program. And obviously they're taking their lead from a certain taxonomy, but it's also their own taxonomy. And then the investors talk about, well, you know, there's another 300-page taxonomy that we not only have to read, but we have to follow. How do we solve for that? It's a real issue, isn't it?
It is. Hence the importance of international cooperation, and that seems a bit of an open door, but as mentioned before, look at the taxonomies. There's the EU taxonomy well underway, huge effort as in other jurisdictions. China has its taxonomy, so now there's the International Platform on Sustainable Finance that tries to find common ground, and it's called the Common Ground Taxonomy. So that would be an example of an effort where you try to understand where there's overlap and hence facilitate investors or other stakeholders to come in and ease the job for them. At the same time, as we've discussed from a standards point of view, but also from a topical point of view, like biodiversity, the local aspect can't be ignored. So for some of these standards or frameworks, one has to differentiate across sectors and across geographies, and that's the reality. So that makes it more complex, but I think we'll have to live with it.
Please speak on this. I think it's quite interesting, China. Playing devil's advocate slightly, but I can remember when green bonds were kicking off in China, we'd see big Chinese banks doing $3 billion green bonds, and it wasn't entirely certain where that money might be applied. It seems like that market has developed and grown and matured.
Yes.
Perhaps you can speak quickly to that, but also one of the things people say about the Chinese market, we talk about transition and whether there's actually a taxonomy and a framework for transition finance in China, or whether that's coming along.
That's exactly the question I want to answer. Thank you very much. So I want to record about what Mikhail just said about common grounds taxonomy between the EU and China. So these common grounds is actually literally between China and the EU. And by the end of last year, according to the data from PBOC, the Central Bank of China, 80% of these two taxonomies has already harmonized, so which means they can explain each other, so which is a huge leapfrog from where we are 2 years ago, since this common ground was published in 2021. And on the other side of this green bond market, I already gave a number of how fast it has been growing over the last few years, 6 years. And even, let's give you an example, even during the COVID restriction period of China last year, before we lifted all the restrictions, in October month last year, a single month, we helped Guangdong provincial government, Hainan provincial government, Shenzhen municipal government issued 3 offshore bonds. Each of that is no less than 3 billion Chinese yuan globally. So that was how actually the market is still growing. It's not always on the news, and it's not always reported here by the local media here because of the language, because of the focus, but the market itself has been growing really fast. So the first half of 2022, we have CICC, a single investment bank, has helped issuing 33 green bonds in China and abroad. So which is mainly focused on Chinese like issuers. So that is growing fast. And what we look at is going forward with this aligned taxonomy, why can't we align the investors here more to Chinese issuers? Why can't we align more Chinese investors to the issuers here? I think we think there will be huge, not only for good for the disclosure, because the more we understand each other, the more transparency and the more trust build, and the disclosure become much more easier, because disclosure always a subsequent step based on trust. But also in the same time, from asset allocation perspective, it also brings in a very good differentiator, which is very small correlation between these two markets, as the big economic cycles are not really synchronized between emerging market and the developed market.
I'm sure everyone in this room would be happy if China was more part of the international market and became part of the global market. I'll come to the floor for some questions in a second. So if you just, on this topic of greenwashing, your views on that. I suppose, you know, the loans that you're looking at from the NDBs are pretty well qualified when you look at them. It's not too hard to know whether they fit the frameworks or standards or not.
That's right. I mean, they've been in the space for decades. They've been setting up standards and applying those standards for decades, and we are relying on those standards and reporting it back to our investors. I think there is two sets of issues here in terms of data. It's data that you have to report on the sustainability side, but there is also data on the return side, which is, I think, linking more to something that you're going to talk about later. So I'll hold on for that.
Okay, will do. Any questions from the floor at this stage? Do pop up your hand. Yeah, we have one right at the front here, please.
Hi there, Christopher Marchant, Net Zero Investor. I know this topic's been discussed a little bit at this panel and the previous panel as well, but looking at something like SDR or SFDR, is this going to be helpful to impact investment, or is it going to be a complication due to issues like overly broad categorization?
Who would like to take that on? Yvonne.
Yeah, happy to take it. I think, you know, you need to have some sort of framework. You need to have something to actually aspire to or compare yourself to or whatever. And I think the important thing is that you know, none of the regulatory, or sorry, the kind of categorizations that are either under development right now, let's say in the European session, or ones that are already in existence are compulsory, right? So it's not the case that you have to be an Article 8 or an Article 9. You can opt out of those and be something different under SFDR, for example. But I think, you know, it provides a framework to aspire to. If you want to be in that market and you want to be categorized as dark green or light green or however. So I think, look, you need to have something. That's the first point. The second point is that, as I mentioned at the outset, there is a framework now within which there's a review and testing phase happening, and I think that piece is really important. There has been a lot of feedback on something like SFDR, and you know, Commission responses were talked about earlier on, European Commission responses, some questions on the SFDR. Similarly, when we talk about the EU taxonomy, there's, you know, questions and answers documents that could be quite helpful to illuminate on some of the issues that are outstanding in that space. But I think that the main thing is that, you know, we are in a moment of learning, we're in a moment of reviewing and testing, and the changes are still possible. And the taxonomy, the EU taxonomy, for example, off of which a lot of the further regulatory architecture is built in Europe, is well known to be a live document. It's well known to be something that market participants are asked to respond to on a regular basis. For example, if you have an economic activity that's not currently categorized in the EU taxonomy, there is a space within which you can, you know, report on that and make a case to say that you think it should be part of the taxonomy, or explain your experience or whatever. So I think that that's the main thing to say there, is that we need to have something to aspire to. We need to have a framework. There is no kind of push for you to be one thing or another thing, but certainly it's important that we keep a close eye on developments, that we continue to learn and review and improve. And that, as I mentioned earlier as well, is the next phase where there will be that opportunity as well within the sustainable finance, the platform on sustainable finance, for that feedback loop to happen and for further efforts to be made.
Thanks, Yvonne. I've already had the 10-minute warning sign flashed at me, so I know there are trains to be called at the end of this. So do we have the results of our poll? And we'll come to that. Should impact investors have to accept a lower return? 83% no. What do your investors want from this, Sophie?
They want a market equivalent risk-adjusted return, and there is no reason to accept a lower return for impact. The reality of our clients, who are, again, large pension funds in Europe, is that their core mission is to provide long-term financial stability for, you know, their retiree or their shareholders. And for them, they need that market equivalent risk-adjusted return. And in order to determine this, they need to be able to assess the risk. And again, it comes to one of your prior questions, it's what could be the role of the MDBs here? The MDBs and the DFIs have a key role to play here in terms of providing the data. These entities have decades of experience. They are seated on a huge amount of market data. And it started to come out. There is the GEMS database, which is the Global Emerging Market Risk Database Consortium, which has published a lot of the data on an aggregated basis, whether it's default rates of portfolio, but the recovery rates were not included. And that's something which is going to be very important if we want to mobilize capital of private investors, because there is a very big gap between the perceived risk and the actual risk in emerging market and in certain asset class, in ours particularly. There is a very big gap in terms of that. If you look at the history today in private investors' portfolio, infrastructure debt is a normal asset that they all hold. 10 years ago, or 10, 15 years ago, it was not the case. And what was the key change here was Moody's that came out and published all the data in terms of the default rate, the recovery rate. And that's exactly what needs to be done. More disclosures in terms of data so that investors can understand the risk, price the risk, accept the return, which is currently out there, which is a market equivalent return. They do not have to accept a lower return, and our investors do not accept a lower return. They want a normal return with impact.
One of the products that you mentioned earlier, Michiel, that's sort of starting to have some traction, particularly in Latin America, strangely, is the KPI-linked bond programs, which says basically that investors should get a lower return if the issuer reaches certain targets and goals, effectively, because the coupon will go down according to how they do. Is that a product that can sort of supercharge this market? I mean, we've talked about 4.2 trillion a year. We've talked about ILX sort of, having $1 billion fund, but there's a lot of ILXs needed to meet the need. What is something like a KPI-linked market the way to go forward here?
So I think, we've got 5 minutes left. Discussion would last much longer. Just a few thoughts. So in theory, this sounds great because you align incentives, assuming that you put out the right KPIs, as we've been discussing, material KPIs for the business and the geography that you're active in. So in principle, yes, but then there might be some ethical concerns, as an investor, you get rewarded for failure on important topics, which on the one hand makes sense from a risk-return point of view, but equally you're incentivized for your investee company to fail. So there's a few elements there. But it does come back to what Sophie said on risk-return, and to get to the more formal question here, I'd agree with the no, knowing that there is a spectrum. So for most of the institutional investors or the sovereign wealth funds and the pension funds, I'd say there are investment opportunities out there where from a risk-return point of view it makes sense. However, if you start shifting towards that concessional capital, if you look at philanthropic money or public money that might come, for example, from carbon pricing, you might want to allocate part of that money for more innovative, more risky ventures, where you actually are willing to take higher risk, potentially with lower return, but then you do so because of the societal impact. So that's that spectrum from focusing on financial impact within impact finance going to societal impact. So I think it's the story is more nuanced, but in general, I'd say no, you shouldn't accept a lower risk-adjusted return.
Okay, thank you, Michiel. Johan.
Yeah, I just want to add a bit in a couple of minutes' time, try to manage that. So this question is, I think this question itself brings in a dilemma of investment. Why is that? Because if we come back to the original idea of impact investment, actually on one side is actually charity. On the other side is investment for profit. And then in the between there is impact investment, and there is also sustainable investment. So there is actually a bit of gray area for us to say whether it's pure for profit, whether it's pure for return, or it's actual for charity, or for charitable purpose, philanthropic purpose. And also another perspective I want to bring into this question when we think about it is that when we talk about the low return, it's low return for how long? Because 2 years ago, we are in a zero interest environment. We were talking about how many times Fed needs to raise hike, right? So, but before, and that's how the private sector infrastructure investment, private debt, basically insurance links, security is basically booming because we have an extremely low interest rate environment before. But now look at us, right? Where we are last year, yields almost skyrocket to 5% for a couple of days, right? So right now what we look at is whether this impact of not only charitable, but also sometimes it's social, society, and for common goods can justify for longer higher return rather than for shorter higher return or longer lower return. So that's something I want to add to this question, because I do feel this question has been asked a lot, most frequent questions about impact investment, but the perspective to look at this question is really making more sense to me.
I think we're almost out of time, so Yvonne, I'm going to come to you for the final word on this.
It's probably, I mean, it's not really, a central bank doesn't overly take a view on whether impact investors, should accept a lower return or not. But what I would say is that, if you look at the research on, green financial assets and the general return, it's pretty mixed, right? So I don't think it's a given. That's my personal perspective, that even if there is an incentive or an impact investor is willing to accept a lower return, I just don't think it's a given. And certainly, during the COVID years, there was evidence that green financial investments did better. And I know, there just very recently, there was a reflection on German bonds, for example, and I think the green German government bond was trading more favorably than the conventional government bond. So I don't think. Just my personal perspective is I'm not convinced that is a given scenario, and there's evidence to suggest otherwise.
If we got into the famous greenium argument, we might be here for some time, but unfortunately we're running out of it. So what a shame we can't delve further, but what a very good discussion this has been. In a moment on the stage, we're going to have Alice Carr, who's Director of Public Policy at GFANZ, with Emma McGarthy from OMFIF. But everybody who's here and everyone online, please put your hands together for a fantastic panel. Thank you so much for that discussion. Emma, over to you.